really the idea is that you want enough money in your taxable account to give you flexibility, because that is the most flexible pool. And then you want to make sure that you get enough money out of that tax-deferred account to minimize your future taxes. And so what you need to do is map out your cash flows year by year, income, expenses, et cetera, and that will show you your future tax brackets. And then you can model out how much to convert or how much to contribute to the various pools to see at what point you keep your tax bracket in the future reasonable. Because the other thing you don't want to do is you don't want to convert so much now that you pay more in taxes now to pay nothing later. That may not make sense. So the idea is not to get every dollar out of the, let's say, the IRA. The idea is to get enough money out to give you control, flexibility of your future taxes, and that's going to be individual based on mapping out your cash flows and your future tax brackets, as well as some assumptions around your rate of return during the intervening years.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.